One thing that I did always like about the content that they put out when they were around, rest in peace. Yeah.
And that is why all the prop firm owners are driving Lamborghinis.
Yeah.
There's a reason 90% of traders lose money and why these guys over here are making millions of dollars. But if the market doesn't agree with me, I don't make money.
The moment you need to make money from the markets, you're screwed.
Now, you might be more technically heavy, but you still need to understand what's going on in the world around you.
What's going on, everyone? Welcome back to Risk Reward Radio. This is the show that dives inside the mind of traders and investors who are risking their hard-earned money in order to earn a living. Now, today's guest is no stranger to calling out your favorite influencer online, asking them to back up their claims with proof. Now, unlike a lot of other people, this doesn't come from a place of ego. It actually comes from over a decade of experience in the markets of acquiring a wealth of information about trading and investing. He's very open to the fact that a lot of his success was credited due to just being lucky to be surrounded by the right people at the start of his journey to lay the foundations to find his path of profitability. I'm really looking forward to diving into the conversation today. Without any further ado, it's my pleasure to introduce Ben.
How you doing? You good?
I'm very good, man. Thank you for joining us today.
Thank you for having me. It's a very nice introduction.
Yeah, I appreciate it, man. I want to start off nice and simple. I'm sure you've probably done this many times before, but
A couple times.
For anyone that doesn't maybe know your backstory, would you mind sharing a little bit about how you got into the industry and how you got to where you are today?
Yeah, of course. I'll keep it fairly brief for us. But yeah, I don't come from a finance background any way, shape or form. So basically when I was 17, 18, I kind of got into more of the fitness space. I was playing a lot of golf, going to the gym, things like that, and basically became a personal trainer. So, when I was like 19, 20, I was working in a gym, really enjoyed it. It was great. You get to speak to all sorts of different people, all sorts of different backgrounds, but you're never really going to make much money. And obviously we've got to remember, this is like 13, 14 years ago. So this was pre being a fitness Instagram guru and all this kind of stuff where you could make a bunch of money online doing it, right? It was just old school in the gym, with the clients. Yeah. So I wanted to get out of that. Didn't really know what direction I wanted to go, and was just very lucky. A bit like you said in the introduction, basically. I got very lucky. One of my clients worked in recruitment, and he was working with a small fund that was just starting up, and by fund sizes, we are talking small, like 10 million quid under management when they launched, which is very small, right? I was just there as an account manager, basically customer support, working with the clients, speaking to the clients, but also interacting with the trading desk, right? Obviously what they're getting up to, their performance, etc., to be able to relay that information. So that really kind of exposed me to the industry. And that was my first kind of insight into it. And so it kind of just went from there, really. I was there for a couple of years, obviously kind of learning on the job, if you will. Obviously, I wasn't trading there, but as in like learning in that environment. Still doing stupid stuff, obviously, with my own accounts and making all sorts of mistakes as part of the process. But obviously, that massively excelled my journey, being able to go and sit and speak to the traders and stuff like that. And then I've been, again, quite lucky ever since. So I ended up going and working with Anton Krill at the Institute of Trading. I was there for a couple of years. And we're talking former Goldman Sachs guys and stuff like that. So again, it's kind of like a bit of a lottery ticket when it comes to this side of the industry. And then I've worked at a couple of other trading companies since, now predominantly working, for myself, managing portfolios and client money and stuff like that. But yeah, as you rightly said in the introduction, I've got very lucky with the people that I've interacted with along the way, and been able to get real professional exposure without having to have been working at an investment bank myself or anything like that. So yeah, incredibly fortunate to have made that journey.
I love that, man. It's a very, I think, unorthodox introduction into the markets. I actually want to start right at the very beginning, because one thing that I talk a lot about, or I at least compare, I think there's a lot of parallels between the fitness industry and trading. I think that there's a lot of similarities between how you view and perform in the gym relative to how you perform in the markets. And what I mean by that is it's impossible to rush the process in both of those forms, right?
Yeah.
You kind of, unless you go down the route of steroids, which is a different conversation.
But even still though, I've seen lots of people that have competed and stuff like that, and they've taken stuff along the way. I think people have this misconception, right? Although it gives you a boost, you actually need to train harder. You need to eat better, because you basically make your body a sponge. A lot of steroids are a medication. So a lot of people, when they take them, they get fat, basically, right? So, there's obviously ways of boosting yourself, but there's a lot of similarities, 100%.
Do you think any part of your background as being a personal trainer has helped you in your mindset, overview, outlook, performance as an investor and trader?
Yeah, I would say there probably definitely is a bit of a link. It's probably the discipline element, right? A bit like trading, you need to obviously have a winning strategy, a proven edge, but then that needs to be accompanied by the right psychological makeup, with the right risk management, all these types of things. Now, it'd be the same as if you go to the gym. You could have a fantastic training routine, but if you don't have the discipline with the food outside, you're never going to do it. If you haven't got the emotional control to be able to, sometimes push yourself when you don't feel very, very up for it, basically, those days where you feel a bit tired, you're just laying and you don't go. If those elements don't line up, then you're not going to have the results there. So 100%, there's a lot of similarities, and it probably, without even me realizing it, probably did just naturally kind of carry over and definitely help my journey on, within this space. Yeah, 100%.
Yeah, I look at this a lot, and like I said, I talk about this openly about, I think there's a big relationship between how you view going to the gym and how you view what you do in the markets. Because much like you said, I think there is a direct correlation between the levels of discipline that you need. Doing what you need to do even when you don't feel like openly doing it is a really, really important part of how you approach the markets. But most importantly, I really like the analogy that you gave. And I say something very similar, like it doesn't matter if you have the world's best chef that will cook you the best food. It doesn't matter if you go to the world's best gym with the best equipment, right? There is nothing that will give you a six-pack overnight.
No.
It doesn't exist, right? And I think for a lot of people that are watching this that have aspirations, dreams, visualizations to make an abundance of money from the markets, you have to play with that long-term perspective.
100%. It's a compounding effect, right? So, be like when you first start at the gym, you're like you said, you're not going to get results overnight, right? But you kind of chip away, all these little 1% and that. And all of a sudden you look at yourself in a year's time and you're like, oh, wow, look at this picture of me here to this picture of me here, right?
Yep.
I mean, I noticed that myself. When I was in my mid-20s, I got right out of my training. I was working uptown. I was going out a lot more and stuff like that, basically. But for the last 8 months, I've been back in the gym training 5 days a week and stuff like this. And although I look in the mirror and I can kind of see there's obviously a difference, but then I look at pictures and I'm like, oh, wow, my shoulders have really filled out, my arms have filled out, this has changed, because you're able to suddenly look back. So all these little bits have added up, and now, bang, you've got a big difference over here.
Yeah.
Like you said, trading's the same. You make 1% on £1,000 account, doesn't really make any difference, right? But as that account gets bigger and bigger and bigger and bigger, now when you make 1% on £100,000 account, that's £1,000 in your pocket, right? And you might have made that in a day. And it's like, oh my God, look at that as a difference. But that journey along the way doesn't necessarily feel like big jumps. But when you compare these two big steps, it's a massive difference.
Yeah, I like that. One thing I want to talk about, again, earlier on to your career, and you've always been very open to this with any podcast that I've seen you on, is you went down the same path that most people make with the early mistakes. What mistakes do you feel like you made, and what do you feel like you did differently to start to escape them? Because I speak to a lot of traders that are constantly just stuck in this never-ending cycle of lack of discipline or lack of patience or no management over risk or whatever it is. So what mistakes do you feel like you made, and what do you feel like you were able to do differently?
So I definitely made the mistakes of obviously, starting with a £500 account, right? So you start over risking because you make a fiver and you're like, all that work for a fiver? Like I've journaled my plan. I've done this. I've made a fiver. Well, cool. What was the point in that kind of thing, right? So you over risk, you do silly things, you take big dents. You might have some big wins and big dents. But this is why I'm such a big advocate now of having a mentor and things like that, because being able to go into the office and have these guys just very bluntly tell me, you're an idiot, do this, not necessarily in those words either, but you're an idiot. This, what I mean? They really held you accountable. So there was a guy called Ken that I used to speak to quite a lot. He was quite open with his time, basically. I'm very, very fortunate for that. So he, I would interact with him a lot, basically, when it comes to like bouncing things back and forth. And yeah, he would, just say as it is and be like, well, look, that's not part of your plan. Why have you done that? So it kind of gave me that person to bounce off of. And like I say, that accountability factor, right? So if you've got a mentor, it's the same sort of thing. If you know that you've got, a session coming up with them in a couple of weeks' time, do you want to sit there and show them what you're about to do? What would they say about that? Do you know what I mean? You sit there and go, I'm going to get in trouble if I do this. I better not do that. Do you know what I mean? Little silly things like that. It will, because then what it's doing is, it's not making you reliant on that person. It's instilling those habits subconsciously. So although at the beginning you're thinking, Sanji's my coach. I don't want him to see I've done this in 2 weeks' time.
Yeah.
But eventually that now becomes a default habit of mine when I'm actually now just executing on my own. So those routines and things like that, it kind of just instills it in you, like I say. And then over time, that really helps kind of create those factors that we spoke about earlier on, discipline, strategy, all these sorts of things, they start to line up. So I've done all the classic stuff, but I had someone to then hold me accountable, and I think that's a massive stepping stone in my journey, 100%.
Yeah, I like that idea a lot because obviously I work with a lot of traders purely from the psychological standpoint. And I speak about the same thing. I'm like, at the start of our journey together, there's probably going to be some new things that I can teach you, share with you about the mind, the psychology, whatever it is. But after a certain point, our relationship is basically all accountability.
Yeah.
And I think a lot of people struggle with this because they come into this industry with the illusion that I'm here to have ultimate freedom.
Yes.
But actually, freedom for a lot of people is the worst thing that they could have because without rules, without structure, without a plan, it's easy to lose everything in a very short space of time.
You need to have a routine. I'm a massive routine person anyway. Like an example is at the moment, I get up and I go to the gym first thing in the morning, right? I always do it. I get up and I go at 7 o'clock. Now, it could be a bank holiday Monday. It could be a normal day. It doesn't matter. I get up and I go at 7. That is my thing. My girlfriend might say it's very over the top routine, be ADHD or whatever, but it's like, that's just kind of the way that I like to do things. I'm doing it at the same time because then I feel good in the morning. By the time I finish, I like how I feel afterwards. Sets me up for my day. That is part of my routine. And if I ever break that for some reason, I feel so all over the place. But then that is the same thing carrying through into how you do everything, right? How you do anything is how you do everything. So then my routine with my trading, making sure I've done this. I've followed my macro stuff, my fundamentals before I'm looking at charts. Having that routine and process, it all translates all throughout your life. So if you can instill those habits everywhere, it's very easy then to carry over into your trading.
Yeah, makes complete sense to me. Complete sense. So let's fast forward a little bit of time. You obviously started out in the hedge fund. You had your initial exposure to a lot of mentors that gave you that level of accountability that you needed. Talk to me a little bit about your time with Anton Creel. Because obviously that was the time when you said you were introduced to a lot of people that worked in like Goldman Sachs. They did this at a very high level, completely different realms to the retail investor or trader that we are exposed to on a day-to-day basis. How did that experience mold your journey? What did it teach you about the markets that you felt like set you up for a path of profitability?
It massively shifted things for me. I mean, obviously I'd had an exposure to it at a certain extent in terms of the way that the guys were managing things at the fund and stuff like that. But then obviously being able to go from that to then quite literally sitting next to Anton, for example, and stuff like that, meeting the different mentors that worked at ITPM and things like this that all have the similar background, that massively changed things. And being able to, it's silly things, right? You go to, for a dinner and stuff like that, and you're sitting there chatting to guys and things like this from all of these backgrounds that are doing all these things. And you'll notice that there's a lot of patterns in certain things, right? How they generate ideas, the way they go about managing a portfolio. These guys aren't sitting there taking a trade this morning on euro dollar, risking 1% of their account. It's very different. They're building portfolios, whether that be long short portfolios, multi-asset portfolios, adjusting weightings depending on their economic outlooks and things like that. Their process for generating a trade idea. Now, as me and you discussed sort of before coming here today, there's obviously differences between what a fund will do and what John Smith will do in his bedroom, right? Yeah. Because you've got different levels of capital, stuff like that. But there still needs to be a certain element that you're replicating of what the pros do because they are the majority of money in the market. If they've developed a trade idea and it's a consensus of a particular stock or whatever, or that asset class, money's going to flow in or out of that asset, and therefore that is going to be where price goes, right? So you've got to kind of understand what they are doing and be able to kind of essentially ride their coattails effectively, right? And again, it doesn't mean you have to do it exactly the same, but you have to be aware of certain things, understand certain things. An easy example would be how much or how little you use technical and fundamental analysis. Now, you might be more technically heavy, but you still need to understand what's going on in the world around you because you've got to be able to express that view in some way, shape or form. Interest rates are changing or inflation's going up or down or whatever, that's going to affect asset prices. So you might be very technically heavy in how you execute a trade idea and stuff like that, but you still need to have a bit of an understanding of what's going on in the world, like I say. So how much or little you use these things, but there's always concepts that you have to be using. And this is what I try and talk about a lot on Twitter and things like that a lot of people, I think, discredit because they go, well, we're not trading the same as a fund. So, it doesn't matter that I don't look at any, economic data and fundamentals and stuff. You go, okay, well, you keep doing that then. But There's a reason 90% of traders
Yeah.
lose money and why
Yeah.
these guys over here are making millions of dollars. So you choose what side you want to be on. You want to keep doing that, not a problem, but you're going to run into issues and you're not going to get where you want to. You've got to be open-minded enough to understand, how markets really work, basically.
Yeah. So from what I understand, I've followed Anton Creel for a little while. I'm actually a big fan of his approach to the markets. It sounds very methodical, logical, makes a lot of sense. Would you say a lot of the influence from that time period is what drove you to have a predominantly approach which is focused around managing a portfolio versus like day trading, for example?
Yeah, 100%. So that kind of approach, the approach that we use is more of a systematic top-down approach is how you would look at it, right? So you're building an overall kind of view based on the macroeconomic elements. That's sitting there basically saying, how aggressive do I want to be? How defensive do I want to be? What sort of economic condition are we in at the moment? Expansive, contractive, do I want to be bullish or bearish certain asset classes? And then you're drilling down from there. So you go, okay, right, well, I want to be, I'm very bullish on the US economy at the moment, so I predominantly want to be long US stocks. Okay, well, now I need to find sectors that are growing. I need to find individual companies that are performing well within those sectors. You're working your way down in that methodical process, right? From there, that's going to basically develop essentially a watch list, right? And now you're going, right, these are the things that I would like to own if the market is now agreeing with me. And I think this is then that kind of middle step that a lot of people miss, that kind of connects the fundamentals and technicals. I could be incredibly bullish on stock A, but if the market doesn't agree with me, I don't make money. Doesn't really matter what my view is or why I think it. If the market doesn't agree with me, if the stock doesn't move, if it doesn't have any momentum in it, I don't make any money. If I'm buying something, it still has to go up for me to make money, no matter what analysis I've done behind the scenes. So that's when then you kind of overlay the technical element. But about 80, 90% of what you're going to be doing is done over here. Your ideas are generated from predominantly the fundamentals, obviously with a macro overlay, your timing of an idea, then your execution comes from the technical element. Now, that kind of balance can shift a little bit because obviously if you're trading more on the shorter end of things, time frame wise, the fundamentals don't make as big of a difference necessarily, but there's still obviously a driving force behind price.
Okay.
So if you're looking out over a 3, 6, 12-month time horizon, it's going to be pretty much all fundamentals are going to drive where the price goes over that point. Where a stock or currency pair or whatever goes this week, that can be more sentiment driven, more price driven, things like that. But there's still, that's going to come from somewhere, if that makes sense, right? That sentiment might be because something's gone on in some macroeconomic data releases. That's maybe caused a shift in sentiment for a short period of time before things line up. So you've got to kind of really balance how much or little you use of each. Develop your own process, obviously, around it. But ultimately, you're using a blend and a cocktail of all those things, really.
Yeah, makes sense. Makes sense. So is there any part of your approach or any part of your time that's spent that's actually still day trading or shorter term trading? Is that something that you still do?
Very, very rarely.
Okay.
Very, very rarely. And a lot of that comes down to, market volatility. At the end of the day, in order for you to make money, something has to move, right? The majority of the time, the day-to-day movement in most assets that are liquid enough for you to be trading in any kind of decent size, they're not really going to be moving enough that it kind of warrants the risk to reward element, right? Forex is probably a great example of that. Everyone's so big on Forex when they come into it because it's the main broker spiel of it's the biggest, most liquid market in the world and blah, blah, blah. And yes, that is obviously correct. But you go and open up a chart of euro dollar and you look at the range that it typically works in. And then you look at a stock and a company that's been growing over the last 10 years and you look at those two 10-year charts and you tell me which one looks best to trade. And one does this over time and the other one just does this. The majority of the time, like when euro dollar or something like that gets in a range for like a month or so and everyone's like, oh, it's so crap. It's like, this is normal. If you understand how assets move, you understand that those types of assets don't move that much. Therefore, by default, the opportunity set in those assets over a short time horizon becomes less. Now, if you understand that, you can obviously now still make money trading that way because you know when to sit on the sidelines. But most people don't because they don't understand what's driving an asset. So therefore, they're trying to trade during these crappy, choppy conditions rather than going, okay, well, my view on the Eurozone is this at the moment. My view on the US economy is this. I don't think that the currency pair is going to go much at the moment. There isn't a big catalyst because of X, Y, Z, blah, blah, blah. And then when price is sitting in that range, you understand, okay, well, I'm just going to avoid that at the moment.
Yeah.
Then if the factors driving that market change over time and we break out that range, then the volatility might be increasing. Well, now could be a time for you to now be implementing your day trading strategy or whatever it might be. You've still got to understand when to be in and when to be out. And I think a lot of the time people go wrong in FX because they're trying to constantly day trade a market that just doesn't offer that kind of opportunity. So they shoot themselves in the foot. They make money for a couple of months, then they typically give it all back. You probably work with traders that do this all the time, right? Do well, give it all back. Do well, give it all back. They're break-even traders over 12 months, but they've made money in pockets and then just lost it in pockets because they don't know when to sit on their hands. And that comes down to lack of understanding again, like we said.
I can relate to this a lot personally, and I like to be very transparent about my journey as well, because I've been trading, or I would say I've been watching the market since 2012.
Okay.
And so I predominantly only monitor or actively watch currency pairs.
Okay.
But when I started with currency pairs, they were a much more volatile asset than they are now, right? So I remember the days where NFP, you would get like euro dollar or cable.
Around,
right?
yeah.
It was a big mover. Whereas I feel like, and you can measure this over time, you pull out data and you can actually see that currency pairs have become less and less volatile over time. So for someone that has a shorter term approach, to only stick with currency pairs doesn't make sense. And the exact cycle that you talk about, again, I can relate to in my journey, where I feel like where I actually started to feel like I made breakthroughs in my trading was me initially stopping just consistently losing money and then moving to the break-even cycle.
Yeah.
And a lot of it was about exactly what you said, right? I'd clean up over a short enough period of time, but then I'd get chopped out.
back.
Yeah, 100%. And I think what's improved in my approach, instead of deviating and looking at different asset classes, which would probably be more beneficial for me, was just learning when to sit and wait and do nothing. And this is why, for me, actually having multiple sources of income was beneficial, right? And I think this is a big thing that a lot of traders overlook a lot. There's this big dream that gets sold that 30 days, 60 days, 90 days, you could be a full-time trader, you could turn your life around.
Yep.
And actually, it's a very unpopular opinion, but anytime I'm coaching someone or have a workshop and I'm talking to them about psychology, I'm the biggest advocate that actually in the shorter term, especially if you're new to the markets, having this dream or idea to be a full-time trader and only make money from currency, from trading in general, is the worst fucking thing that you could do.
Yeah, 100%.
The moment you need to make money from the markets, you're screwed.
Yeah.
Right?
It sounds great, right? Make 10 grand a month trading the international Forex markets. And, the adverts look fantastic for it. And what you see on Twitter and social media and that sounds fantastic. But it's just not the reality, like you say. And I think, it's a big learning curve for most people. Well, some people never actually get to the point of learning that. They kind of just sit there and eventually go, oh, Forex is a scam. It's like, no, you just don't know how to trade. Yeah. There's a difference between the two things. But yeah, I think there's definitely, if when you can understand that, and like you say, your performance will increase by just taking less shit trades.
Yes.
Right? So your P&L doesn't necessarily always get better. You haven't got to try and find more good trades. Just take out the crap.
Yep.
If you can avoid taking one less shit trade per month, and you're risking 1% per trade, you've just saved yourself 1% a month. Compounded, you're about 14, 15% a year better off.
Yep.
And you haven't done anything extra, you've just done less, right?
100%.
So there's, those two things kind of correlate, and you've got to kind of work out, and again, that's what we said earlier on, this is why it's so important to have a mentor. It's better sit there and be able to go, shouldn't be doing this, you're over trading here, you're doing this wrong, because not everyone can always necessarily see that. And I think it's very, very important, and having that outside influence can definitely kind of help you improve a lot quicker. Yeah.
I see this a lot in, I think the typical trader that I work with usually has an edge in the market, right? Like my ideal client is not someone that can't have an edge that they can't quantify over time. I'm a big my niche is psychology, my niche is mindset. But the big thing that I start with when I sit down with someone, if we're going to go and have coaching, is, do you have an edge? And if you do, if you're telling me you do, how do you know?
Yeah.
Right? What data, what metrics, what journaling do you have to support the fact that over X time period, you actually have an edge in the markets? Because the majority of the people that tend to do well off the back of at least the approach that I have with people is a lot of, they actually can make money during periods of time. They have a market condition where their edge works really, really well.
Yeah.
And where I help most people is just controlling the bottom line. Right? It's stopping them from making those silly mistakes. It's stopping them from rushing in when there's really no opportunity there. And a big part of that process, I think, and it goes back to what we mentioned before, is actually getting to a position where you can detach from money, which is very, very difficult, especially to
It
the
is difficult to do.
newbies, right? Do you have anything from your experience that you learned from the professionals or in your own experience that would help people to develop that level of detachment?
So I always get asked this, and to be honest, I'm not somebody that really focuses on money much.
Okay.
And I think I'm just a little bit more like that anyway. Like, I'm quite happy to take a risk sometimes and I'm not talking trading wise here, but sometimes, you take on I like betting on sports, for example, and things like, I like going to the casino, I like playing blackjack, I play poker, I'm a little bit more like that as an individual anyway. And so the way that my kind of brain has always worked is I'm always trying to work out probabilities, work out my potential payoff. A good example of this is when you're playing poker. If, I don't know, let's say somebody's raised, right, and now you're trying to work out, should you call when there's one more card to turn over and there's a certain card you're waiting for, what is the probability of that card getting hit? What is your potential payoff if you now call? Because sometimes you've always got to make that call because the probability might be a 5-1 probability, but you're getting a 7-1 payoff.
Yeah.
You take that bet every single time.
Yeah.
So because my brain just kind of works like that, I'm happy to take a controlled risk, and I'm always, as long as it's a managed risk, and like I say, I'm calculating probabilities and stuff like that, I'm always happy to do it. The way that then translates obviously to my trading, I'm never really looking at the P&L from a monetary aspect. I'm always thinking percentages. I'm always thinking, is this the right thing to do given all the information that I understand, and taking a level of risk that I'm then comfortable, within that environment on, basically. I've never really been someone that looked at, I'm up X amount of pounds, down X amount of pounds. Like, anyone that follows me on Twitter will notice I never speak in monetary terms. You could go through my whole Twitter history. You will never find me talking in monetary terms because it's not relevant.
Yeah.
I actually put a tweet up about this earlier on, is that, if anyone's talking to you in monetary terms online, they're normally trying to sell you something because that's what they're trying to do. They're trying to go, oh, look, I made 10 grand.
Yeah.
Because they want you to go, I want to make 10 grand.
Yeah.
Right? So they're using it as a way of bringing you in to sell you something. If they said I made 2%, doesn't really sound as sexy, right?
Yeah.
So that's generally the case, but that's how real traders will look at it. They'll sit there or take it one step further. They'll sit there and be like, I made 10% this year, but the volatility in my portfolio is X. My risk-adjusted return was X, Y, Z. And they'll compare that to the benchmark. They won't just sit there and go, I made 10% or X amount of pounds. So there's different ways of looking at it, but I think you've got to try and do your best to come away from the monetary element and focus on the other components. It's not easy to do, and some people are better at it than others. Some people are more inherently terrible at it, basically. And general rule of thumb, humans are bad traders from a psychological aspect. And a lot of people, they actually do better when they shift to a very systematic trading approach or more mechanical trading approach because they find it easier to remove that human element in it. So I don't have any tools or tricks per se because it's not really the way that I am. It's not something that I've really struggled with, but it's definitely something that you need to try and get out of if you are someone that just focuses on that P&L in the bottom left corner.
Yeah. Very interesting. I think this pivots on nicely to a conversation that I really want to dive into a lot, which is managing a portfolio. Because the vast majority of traders that I speak with, and again, this includes my approach to the markets, is not really based on managing a portfolio. It's just finding probabilistic opportunities in the market and getting involved in that time. And then otherwise, I'm just going to sit on my hands and do nothing. From what I understand, and again, please correct me if I'm wrong, when you're managing a portfolio in your approach or maybe how you've been introduced to it, is there ever a time where you're sitting in either all or a large chunk of cash and just waiting for good opportunities in the market, or are you constantly invested?
So for me, I would say a good 99% of the time I'm going to be fully invested.
Okay.
The way it will shift will be not a case of, oh, I don't think there's much opportunity in stocks at the moment, so I'm going to sit in cash. It's a case of, well, there's no opportunity in stocks. Why is there not? Where's the money going? Because money doesn't vanish.
Yeah.
If you look at historical correlation between things like stocks, bonds, commodities, etc., they're all going to do better and worse in different economic conditions. So there's a famous way of looking at it from Ray Dalio, and I think he actually took it from a guy called Harry Brown, but you can basically split the economy up into 4 different quadrants, 4 different economic conditions. You have economic expansion, economic contraction, inflationary environment, deflationary environment. You typically are going to sit in one of those 4. Now, if you then study those environments historically, a certain asset class will do better and worse in different places. So if you look at the reason why stocks have been the best performing asset class historically is because predominantly most of the time we sit in a condition of economic expansion, more of a risk on type environment, right, where people are happy to take risk, and that's where the money will flow. If we go to economic contraction, businesses slow down, things like that, the economy slow down, bonds tend to do better. People go to that safe haven asset, pick up a bit of yield, etc. If we go into an inflationary environment, so 2022, commodities, gold, things like that do well. If you go into a deflationary environment without economic growth, again, bonds tend to do better. So if we're finding that we're shifting between one of those four quadrants, you're going to find that money's obviously going somewhere, and therefore there's opportunity set elsewhere. So you do get kind of market neutral portfolios where that would basically be you sit there and go, well, I'm not going to try and predict where we're going to go. I'm going to have exposure to all of these. Now, you wouldn't necessarily be 25% in each kind of quadrant because you've got to then adjust volatility of assets and stuff like that. But we won't overcomplicate it, right? But essentially what you're doing is you're saying, well, as long as I've got exposure to everywhere, what Ray Dalio refers to as an all-weather portfolio, and that doesn't matter what happens, I'm going to be okay. That doesn't mean you make money in every single market condition because, you know, if I hold bonds and bonds are doing well, it also means other things are going down, right? And it's not necessarily going to offset directly one for one. But the idea is that, let's say you was comparing it to, say, being invested in an S&P 500 index fund, and you get a 2008 scenario where the market's down 50% at one point, a drawdown, you might only be down 15%.
Yeah.
So what you're doing is you're tightening up your dispersion and your kind of standard deviation in your portfolio. Now, of course, that's kind of more of what you refer to more kind of risk parity effectively, right? You're trying to neutralize as much as possible. But then, of course, a more active individual might sit there and say, well, depending on the economic condition we're in, or I believe we're moving to, I now want to shift my weightings. So if we think we're going into an expansive condition, I don't want to hold bonds and commodities. I want to be 100% long in stocks. So you might kind of rotate there. There is also then obviously some people that run long short. So it might not necessarily be that you go into other asset classes. You might de-risk or reduce your exposure in an asset class by actually now being short in a particular area. So stocks would be a very easy example. Let's say you've got a lot of tech exposure, but you think there could be some downside in equity markets, but you don't want to sell the shares you've got. You might now reduce your position there, maybe short the sector or short the market as a whole to kind of offset your long exposure now. And if you do get a correction, you should reduce that drawdown as well. So there's different ways of doing it, but you're predominantly always going to be invested in some fashion. It's very rare you're going to sit on a big pot of cash. The only time that's ever going to happen is when you get your extremes, your Warren Buffetts, right? They've just got so much money, they can't physically deploy it all. Right. But of course, none of us are going to have that problem anytime soon, so we don't have to worry about that, right? We can focus on doing it the other way around.
Fair. I like this train of conversation because I think a conversation that I've had and possibly others are having that are listening to this as well is, if you are always invested in the market, do you have a game plan, or maybe it's something that you learned recently? Like, how do you deal with periods like COVID? Like, when there's so much uncertainty in the market, and yes, clearly from how you view the market, money is always going to be flowing somewhere. Yeah. But when there is so much fear, I think is probably the right word to sum up for COVID, and uncertainty about what is to come and when it's going to come about. Because I think from a logical standpoint, we'd agree that some industries, some firms, they're never going to disappear, right? If they dropped 50% tomorrow, it's a fantastic buying opportunity. Yep. But with all the media, the fear, the uncertainty that's driven during times like obviously COVID, which is one of the most recent ones, how do you manage your portfolio? Is it any different, or are you doing the exact same thing?
You turn off the TV. It's normally a good starting point. Don't sit there listening to all the news and stuff like that. I mean, and that is actually generally quite a good thing to do from normal day to day, to be honest with you. You've got to remember that news outlets, stuff like that, they're there to get eyeballs and clicks.
Yes.
So they're going to say the stuff that catches attention. So they're going to over-exaggerate and things like that. That's just the default of the business that they're in. So whilst I might have Bloomberg on in the background sometimes, you're not really paying attention to it. And what you've got to remember is news is reporting something that's happened. So even if it's important information, it's already priced into the market. So there's no relevance to you as a trader and your trading decisions, right? But I mean, if we use COVID as an example, and this is why having different types of analysis is important. If you actually look at it from a macroeconomic aspect, there were signs of the economy being overheated going to the back end of 2019 anyway. Okay. So now, if you kind of, sometimes it's easy to say this in hindsight, right? But kind of looking back on that period, well, what a portfolio manager should have been doing at that point is taking some risk off the table if they was 100% long stocks anyway. So that should have been a scenario by where they was either diversifying into different asset classes, maybe hedging out some risk, things like that. So firstly, when you then have that then drop that comes out of nowhere to a certain extent, in March of 2020, and I think the market dropped about 11% just in March on its own. It was down about 36.5% peak to trough in terms of the S&P. You shouldn't have taken that full loss or full drawdown, I should say, right? Because, of course, if you're still in the position, it's just technically a drawdown.
Right.
The other side of that is if you then start to look at how the market starts to respond as we start to rally off the bottom, we look at how then governments and things like that are obviously responding with their stimulus and things like this, becomes very obvious that basically the economies are just going to get a big boost and a big injection here. So now the logical thing to do is start buying the fuck out of everything, right? I started buying everything very, very heavily in 2020. I made like 30% in 2020. Now, that might not sound too impressive to some people, but I run an unleveraged portfolio. I've got zero leverage, right? So I was able to make 30% in a year where we had almost a 40% drawdown at one point. And sure, I had a little bit of a drawdown in my portfolio, but I was hedged and things like that, so I didn't take the big hit. Obviously didn't know that COVID was going to shut down the world, right? But obviously because of the other analysis and my view on the economies and stuff like that anyway, and then that then obviously gave me some extra capital now to be able to redeploy it towards the bottom and keep basically buying and adding in and then participate in the rally coming off the back of it. But with that being said, nobody's perfect, because then in 2021, I only made about 5% that year because I started to think things were getting a little bit overcooked and started to de-risk and started to hedge a little bit and things like that, but the market just kept going. So although it didn't hinder me in the sense of I lost money, there was opportunity cost because I didn't make as much. But this is then when it comes down to sort of how much risk you're looking to take in your plan, things like that. I would rather take some risk off the table and then miss a little bit of the upside rather than be over risk and then take a bigger hit to the downside. But it depends on the type of portfolio you're trying to manage at that point.
Yeah. I really like that approach and I think answer to that question. I think it, again, makes a lot of sense for the situation, but I think the biggest thing that I took away from that, and again, it's something that I've been practicing for a long time, is just turn off the fucking TV.
Turn off the TV.
Right? Genuinely.
Best thing to do. And it's hard to do, especially if you're on social media as well, right? Because you can imagine what social media was like at that point as well. You would have seen it. So yeah, it can be, at times like that, you've got to sit there and go, right, okay, this is a unique environment. I now need to really disconnect to what everybody else is talking about to be able to get in the zone and be able to focus on, right, what do I actually have? What should I be doing here? What is my view? How should I be expressing it? How do I take advantage of this? Because, and you'll notice if you go and study, a lot of the big investors, your George Soros's, Stanley Druckenmiller's, your Warren Buffett's, all these guys that have made insane amounts of money, you'll tend to find that for the most part, they're normally average most of the time. But then what they have is this ability that when there's a unique opportunity there, they are not scared to go for it, right? A great example of that would be the leverage and everything like that Soros took to when the pound crashed back in the early 90s, and they made like $1 billion in like a day or whatever, something stupid, because they saw something that put the odds so much in their favor that they could really crank up their exposure to it, because from a probability aspect, it made sense. The math made sense, basically. And all of these guys have been very good at that. You look back at all of their careers, there's numerous times where they've got mega aggressive. Buffett did it with American Express. It was something stupid like 50-60% of the portfolio or something like that at one point, or maybe even bigger than that, because it was a unique opportunity. Can't remember what year this was now. This might have been like the 70s or 80s or whatever. But it was a unique opportunity that presented itself. If no one's heard that story, I'm not going to tell it now, but go back and study it, because having so much conviction in a high probability opportunity, and he was happy to go for it. So yeah, I think most of the time you've got to be prepared to be average, but then when you get those unique scenarios, COVID was one of them. When we see the drop that COVID created, become a unique environment. But you don't always take advantage of that if you're listening to all the talking heads on telly, listening to the Twitter feed and stuff like that, because that's only going to focus on the negative and not be very forward looking. So you've got to try and detach during those times.
The example that stands out most for me is The Big Short. I'm sure you must have seen it. Same sort of thing, right? Unique situation. Somebody had conviction to just go with their idea and absolutely cleaned up. So Yeah.
Yeah, prime example, exactly.
Perfect. All right. I want to hit you with a statistic.
Okay.
So obviously you're quite active on social media now.
Yep.
There's a prop firm called the Funded Trader, TFT. Had a lot of controversy about them recently.
Yeah. They fucked everyone over, basically.
Basically.
Right, you work for FundedNext. You can't say that. I can. It doesn't matter.
That's why we're glad to have you here, right? So there's one thing that I did always like about the content that they put out when they were around. Rest in peace. Yeah. One thing I always liked about their content is they gave a lot of statistics about their traders.
Okay.
I want to read out a tweet that they put out in January of this year. And it gave a statistic about the number of people that were going through challenges over a certain period of time. And I want to hear your thoughts on it. Okay. Maybe you would have heard this before, I don't know. But I found this one interesting. And I've literally got this bookmark. I use this in workshops that I give about psychology and all sorts, right? So they tweeted in January, in the last 60 days, here are some interesting stats. Traders that have failed 3 or more challenges over 60 days, 11,957. Traders that have failed 6 or more challenges over the last 60 days, 3,468. Traders that have failed 9 or more challenges in the last 60 days, 1,462. Traders that have failed 12 or more challenges over the last 60 days, 775.
And that is why all the prop firm owners are driving Lamborghinis.
Yeah. But, I mean, insane.
It is insane, but I think it's the problem that's kind of come off the back of all these prop firm type scenarios, right? It's like, if you look at the industry as itself, prop firms, if used correctly, can be a fantastic opportunity and tool. The problem is 99.9% of the time they're not used correctly. You've either got people trying to gamify them, which is then when you hear people online sitting there crying, oh, they've banned me, blah, 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 blah. No, you was just abusing a system that the way that a lot of these companies are set up. Because a lot of these companies don't A-book people, right? So they're just purely, we've made X amount of pounds from challenges, so therefore we pay out this small percentage of people out of our revenue, basically, out of our earnings, right? So if they've got somebody gamifying it, they're going to shut them down. They're going to get rid of them. So when you get people bitching and moaning online and stuff like that, it's like normally it's their own fault anyway. But then there's the other side of it, is that you've got people that, and this is why, like when they took away, a lot of the prop firms, when they took away the whole thing of time limits, they knew that weren't going to make any difference, because the reality is, even if someone has infinite amount of time to pass the challenge, they don't want to pass it in 6 months. They want to pass it now. So it made no difference that it was 30 days or not, because people are still just trigger happy, trying to pass as quickly as possible. And it just has instilled a lot of bad habits in people. But for those people that have used them correctly, they've been a phenomenal tool, right? They've been able to get access to additional capital in terms of the returns they made they couldn't have possibly made with the money that they did have. They can then siphon that off into their own personal accounts even, grow their own personal wealth and stuff like this. This is why one of the things I always say, if you've got somebody that's apparently making loads of money on prop firms and doesn't have a personal account, you want to really question that person. Because either A, they're just full of shit and they're not making that money on the prop firms anyway, or they have no brain in their head, because what are they doing with all their profits? They're probably just out buying fancy shit to then post it on social media to be able to sell you something. So it's, prop firms have been a fantastic tool for the small percentage of people, but for most people, not so. And, obviously you've had some bad apples and some dodgy companies and things like that. That happens in every industry across the world. It's not unique to prop, right?
Yeah, of course.
But at the end of the day, I think, a lot of the time it's the individual's fault as well. People will complain about the way some companies have acted and stuff like that. But a lot of the time it falls on the individual as well. I think, personal greed and stuff like that, and they start getting silly, and that's why you then see statistics like that, basically. It's not a surprise.
I largely agree with everything that you said, but I want to throw something out there to play a little bit of devil's advocate. Okay, so I was very fortunate to connect with a trader recently who had been in the industry for a while. And we were actually talking about this a little bit before we came on to shoot. Been in the industry for a little while, but given up trading. And I was very curious as to why that trader decided to just call it quits, because the vast majority of people that I know, when you get the bug for trading,
just keep going.
It sticks, right? You don't ever stop. And so I was very curious as to why did you stop? Like, they did very well in their time. And their response was, most of the money that I made was from identifying an inefficiency in the market. So their description of an inefficiency was there was something particular that happened at London Open or London Close or around the London Fix. Like they would identify something. It would even be in the sense of maybe they identified a discrepancy in the feed between this firm and this firm, and they were able to leverage that, right? I think the classic definition of what a trader does, trading those sort of inefficiencies, I don't know if that qualifies, right? But they were able to make money from that particular situation. So when people say that they look at prop firms and they gamify it and they don't really care about kind of hitting the reset button and being able to just reset, start again at a fresh account, they just care about the risk to reward of money in versus money
Spent
out.
X made this.
Correct, right? There's a part of me that kind of understands that approach because ultimately everyone's here to make money.
Yeah.
It's the end goal, right? So for those that argue that point that that's their approach and this is how they're going to approach prop firms, I can understand why they do it. However, and this is something that I witnessed for myself. Again, I always say I'm very fortunate that I get to talk to a lot of traders for the very, very small, and I emphasize very small portion of traders that actually do well. It can often be quite difficult to separate the mindset of I trade this way with props and then I trade this way on my personal account, right? A lot of people are trying to run up get through a challenge as quickly as possible and then get the biggest payout possible. But then when you apply that same thing to your personal account and you lose 10, 20, 30, 50% of your account, there's no reset button.
No.
That money's gone.
Yeah. And I think look, at the end of the day, what we're doing as traders and investors is we're looking to identify opportunity in whatever form that may come from, right? So some people argue, for example, that it's immoral to make money short selling, against certain stocks because you're basically betting on the company failing, which they obviously puts all these people out of jobs and things like that, right? You can look at it however you want to. Same as when you can make money from, big short, right?
Yeah,
Markets crashing, loads of people losing jobs, X, Y. I can't remember what the statistic is. They say for every certain percentage that the unemployment rate changes, so many people die and things like that, right? So you've got people making money off of these types of things. It's just another opportunity, right? But you make a good point there in that it's a case of you've got to be able to differentiate between the two. i.e., I'm trading prop accounts in this way because it's enabled me for every 10 grand I spend, I make 20, and I'm okay with that. Firms are going to ban me over time and things like that, and it's going to happen. But it's an opportunity where I can make some money in the short term. However, I don't trade my personal accounts like that because the risk parameters don't make sense and things like this. Most people aren't doing that.
Yeah.
Most people are just going fucking Hail Mary, basically, on the prop accounts. And probably a big reason why a lot of these guys then don't trade personal accounts because they actually can't make any money trading normally. They can't make money, right? They've just worked out a way of being able to gamify these props in that enables them to actually come out on top over time versus what they've spent. But they can't make money in the real world, right? And I find it funny sometimes, like, because some people, I've had comments on Twitter before, like, my track record and everything is very public, right? I'm an eToro popular investor, which means everything is there in the open. Everyone can see what I've done, when I've done it for like the last 4 years. 2022, obviously bear market, basically everything tanked. So I was down like 20%, a 20% drawdown. And you have people go, oh, you lost money in 2022. I go, yeah, I did, but you've also blown up 5 accounts. They're 10% each, right? So how is what you're doing any better than what I've done? Plus mine was only a temporary drawdown of things that I've continued to hold that I've then made money from over the long term. Yeah. So it doesn't really make, but that is also a good sign of how people aren't disconnecting those two, right? They're not sitting there thinking I've blown this account, that's the equivalent of losing 10%. They're just going, oh, it's just an account blown. They're not really realizing what that actually means. If you was to do that on a normal account, most people would just blow accounts up left, right, and center. Like normal accounts, just completely gone, wiped out. But like you say, you've got to be able to differentiate between the two. But it is an opportunity. So if you can do that and exploit it for a while, don't really blame them.
Fair.
Don't really blame them.
So, I mean, there's a clear distinction and a clear separation between people that do well, whether it's in prop firm, whether it's trading personal capital, whatever it is. And I think what we've touched on here is something that you mentioned right at the very start, which I'm a big advocate of the same analogy. How you do something is how you do everything, right? So I think it's inherently difficult psychologically for a lot of people to just have one strict approach to playing the prop firm space and then a completely different approach to playing their personal capital. And it's that difference will ultimately, I think, determine how people do longer term, because ultimately, I think most people get into the prop firm space because they are looking to leverage their maybe smaller amounts of capital to try and grow it, to then fund their own personal account, or at least the people that are smart enough should be aiming for the same sort of thing. What would you say needs to change in the space to help people be more successful longer term?
I mean, it's difficult because I think a big problem with it is predominantly on the individuals, not so much the firms. You know, and we can sit and we can call, say about the bad apples and whatever, but the barrier to entry became very low because for a couple of grand you can go and borrow somebody else's tech, effectively make a landing page on the front of their tech, and then you just have a revenue split with them, and off you go, and people are pumping it like mad on social media. And then, as we've seen with certain firms, and obviously that then not working out very well for them, right? But those bad apples aside, the statistics will still be the same even for the firms that have been around for a long time, your FTMOs and all these types of people, because ultimately it comes down to the individuals, right? And it's a bit like when you've got people jumping straight to prop when they haven't actually traded their own accounts for any period of time. Now, okay, you might only have £1,000 to trade with, £500, £2,000, whatever it is. You need to prove that you actually have an edge in some fashion, right? Whatever your trading style is, day trading, swing trading, whatever, I don't really care. You still got to prove that you have an edge, a statistical edge, and a way to make money over time. Because if you don't, you're not miraculously going to make make the money over here. And you can sit there and tell me all day long about all these back tests you've done and spreadsheets and all the rest of it. It don't make any fucking difference when it comes to the reality of the markets, because putting things into practice is always going to be different in real time. Always going to be different. Don't matter if you've got 20 years worth of data. Always going to be different. So they've got to really identify and really truly understand their edge, both from a back testing aspect, but also a forward testing aspect, and sit there and go, right, I've actually traded, I've back tested 10 years worth of data. I've got a statistical edge based on X, Y, Z. When I've then put it into practice for the last 6 to 12 months, I've also been able to replicate that. So I know that this is my potential upside, my downside, the drawdown potentials, how I need to manage my risk to make sure I fit within. Because that's the other thing. If you know that your trading strategy over 1,000 trades has every probability, statistically speaking, of having 20 losses in a row. But if you've got a 10% drawdown, you now know that you need to basically have less than 0.5% risk per trade to be able to understand and be able to go through any kind of drawdown period within the strategy's performance to not actually lose that account, right? Now, most people aren't looking at it that way because they don't truly understand their strategy, and they don't really understand, yes, this is an equity curve because, I win 50% of my trades. My average winner is 2 to 1. So this means that I make X amount of money over time. Yes, but what is, statistically speaking, how many losses can come in a row? How many winners can come in a row? Understand all these different elements that really go into actually defining an edge. Now, when you're putting it into practice, you know what you have to do, how to define your risk and everything around it, because you understand it. But if you haven't put it into practice, if you haven't tested it properly, all of these sorts of things, you're not going to know that. So therefore, you're kind of just effectively guessing based on some very loose numbers, just going into a prop account, and the inevitable is going to happen eventually. Even if you pass this one, you're going to fail, lose the account. I'd love to know the statistics on how many people keep their account for more than 6 months, because I bet it ain't many.
Yeah, I bet it ain't many. I agree with you. But I really liked what you said there, because there's something that when I talk to a lot of traders about risk, I think everyone looks at risk as a very binary black and white thing, right? Which is, I've been told or I heard risking 1% of your account is the best thing, or 2% or 0.5%, 0.25%, whatever it is.
Yeah.
And something that you mentioned there is, I think, something that not a lot of traders spend time on, right? So I like to view risk management as you need to consider 3 different factors. The first one is your account balance, right? Especially in the prop space, when you have drawdown limitations, you have to know where you are in terms of how much you're risking in your account, right? That's the standard thing, and it's where most people start with. I'm going to risk X amount as a pure black and white of my account balance. The second part, which is the part that you mentioned, which is knowing your strategy, knowing your data, knowing your numbers, knowing your edge, right? Based on your win rate, statistically speaking, how many losses in a row am I likely to take over the next 500 trades? Can my strategy handle that, both in terms of performance if I'm in the prop firm space, or mentally if I'm trading my personal capital? Because if you get crumbled and you're 20% down because your risk is 2%, 1%, whatever it is, you could still be playing completely in line with your edge, but you will crumble mentally if you're not prepared for that, right? If you don't know your numbers.
100%. And it's also, So I'll give you a good personal example of this, right? And something that I've actually been testing recently. So looking at being able to sort of quantify a lot of different strategies and things like that. So it kind of links into what we said earlier on about having different asset classes to cover different market conditions. So we've been backtesting different allocations, weightings on portfolios on something that you could have as a market neutral portfolio, the sort of drawdowns you've then had historically, things like that. We've been testing data going back to about 1972, so like the last 52 years basically. And if you had a particular weighting of say 50% equities, 25% in 10-year treasuries and 25% in gold, over that time period, the biggest drawdown the portfolio would have been 20% compared to over 50% for the US stock market in 2008. Outside of that, the biggest drawdown I think had been about 12%, right? So you massively reduce your drawdown. The volatility of the portfolio basically halves, but you only give up about 1.5% per year. So the risk-adjusted return goes through the roof. Now, on paper, you would then think, well, we could add leverage to that, 2 times leverage, for example. I would then go from about an 8% per year to about 16% per year, theoretically, and my drawdown would still only be 40% compared to the market's 50. Makes sense, right?
Right.
What you're missing on that, though, is that 50% of your portfolio would have been stocks, and at one point stocks drew down 50%, meaning that half of the portfolio would have zeroed. So you couldn't actually do it. So this is where it starts to become understanding the numbers behind, okay, this backtest looks great on paper, but in reality it wouldn't have actually worked. So the max you could have actually done would have been a 1.5 times risk, because then you wouldn't have blown up one part of the account. So it's understanding firstly the numbers and the data, but then understanding how that actually applies to the real world and can it be used, which is why I say backtesting something on an Excel sheet might look great, but then doesn't actually translate in reality. So you've always got to be able to sit there and go, right, you know, how does this actually work from a practical aspect? What potential hiccups can come? What are the realistic potential for drawdowns? How long can they last? How many losing trades in a row can I have? Whatever it is, right? You've got to understand all the different dynamics that make up your strategy and approach to actually be able to then go and apply it and replicate the results in any way, shape or form.
Yeah, 100%. 100%. I think that makes complete logical sense. The last part to that, which was the last thing I get people to focus on in terms of risk management, is, and I find this is often the topic that's discussed the least, which is your own personal risk tolerance when it comes to money, right? We've all come from different countries, different upbringings, different exposure to money. And so 1% of a £10,000 account and a 1% of a £10 million account is 2 completely different things to you. And so how you respond to that psychologically and how you're able to then perform is a very, very different thing. And again, on paper, it looks easy, right? You're like, oh, I'm risking 1%. It's completely fine. The moment money is on the line, it's very, very difficult.
You're watching the numbers fluctuate.
Exactly, right? Everyone's been there at some point in time. So with obviously your position in managing a portfolio and being pretty much, like you said, 99% of the time constantly invested, you've constantly got numbers fluctuating, things changing. How do you go about managing your time off the charts? Because I find this is usually an interesting point of conversation with even short-term traders, because like we've identified earlier in this conversation, there are points in time where the best thing to do in the short term is actually nothing. Sit on your hands and do absolutely nothing. And one of the common conversations I have with people is, what do you do in periods of boredom, right? Because I think a lot of people are attracted to trading because they think it's going to be excitement and flash, and they watch like Wolf of Wall Street and there's loads going on all the time, and they think it's constantly clicking buttons and being in and out on a 1 minute chart 20 times a day. In reality, the majority of your time is fucking boring, right? You're sitting there.
You're not doing anything.
You're going through data. So for you, obviously that has a smaller approach around day trading, short-term trading, and then predominantly managing a portfolio. A lot of your job is predominantly probably just waiting and doing nothing and just observing. How do you occupy your time?
It's a variety of things. So this is again where the gym element I found being important more recently as well. Getting up, going to the gym, things like that. I've got a very overactive, hyperactive brain, right? I barely sleep because my brain never switches off, and I'm terrible for it. My girlfriend will tell you this. I'm absolutely terrible, right? But when I'm in the gym, it's the only time I actually don't think about other things. I don't look at my phone at any point. I've just got my music on, and that's it. For some reason, when I'm in the gym, I completely disconnect, which is why it's becomes such an important part of my routine, not just from a physical aspect, from a mental aspect, because my brain does not stop, and it gets exhausting at times. But when I'm in the gym, it kind of like does. So it's a case of that becomes very important for me. If I don't go to the gym in the morning, I actually feel more worn out at the end of the day.
Yeah.
Obviously, there's the physical element of that as well, stimulating the body, etc. But yeah, I feel more worn out because my brain is just kind of doing overtime the whole time. A lot of my time is then spent data collection, going through data, things like that. We've got like a members group as well, so we'll keep them up to date with bits and pieces and news and etc. I've got a newsletter that I run, so obviously writing bits and pieces for that as well. But then also doing stuff that's completely separate. Very randomly, we look after some dogs sometimes. We do like dog daycare and stuff like that. It's not really anything to do with the money, but it's something separate. Then you go and take the dogs for a walk, or you're doing whatever. I play quite a bit of golf as well, so I'll go golf with my dad or my brother-in-law or what. I would do these things that are completely, in no way, shape, or form related to markets, and it's become very beneficial and very good for me at times, because there's been times where I've gone on a golf day, and I don't look at my phone from a trading aspect to kind of see what the market's done till like the market's closed. Like it'd be about 10 o'clock at night, and I go, I wonder what the market did today. So at no point have I actually in the day seen what anything's done. But I think what makes it easier for me to do that, it kind of ties into something you mentioned earlier on in terms of having a level of risk that you're comfortable with. The majority of the time, my portfolio will either be diversified into other asset classes to a certain degree, or hedged in some fashion. So even if the arse fell out the market and the S&P was down 10% in a day, it wouldn't actually really make much difference to me. My losses wouldn't be that big for a start, but also because I'm unleveraged and things like that, I'm not massively exposed. So it doesn't really make any difference. So it's not like there's a need for me to be sitting there watching my positions, because I'm not going to be doing anything anyway. So having things that are completely unrelated, and then the stuff that is trading related is not about me sitting watching a chart. It's very rare that I'm actually sitting and looking at a chart. I'm normally doing something completely different. So yeah, I would definitely recommend completely disconnecting in some way, shape or form, and having things that you do outside. Even if you're someone that's fortunate enough that in some way, shape or form you effectively trade full time, you can't be sitting there looking all day in front of a chart on a screen. You've got to go away from the computer in some fashion.
I've always found this from even just a mindset perspective. I think the longer you sit and stare at a chart, you will find a reason, or you will rationale a reason to actually get in. 100%. There's no complete reason for it. And it's effectively, it goes back to what I mentioned before, right? It's having a plan for boredom. Your mind is trying to create an opportunity where it doesn't exist. And this is why I put a lot of emphasis, and I like to get inside the mind of people that are able to have that time away to understand what it is they do. Is it something that they're very conscious about? Or is it something that just so happens as part of their life, but actually it carries a great benefit to their trading and their approach in the markets as well?
This is why I think for a lot of people, they're in a rush to get rid of their 9 to 5. A lot of people will trade better when they have a 9 to 5 than if they don't. If you're sitting there watching this and maybe you've made a transition to full-time recently and you're struggling or something like that, maybe get a little random part-time job, right? And it could be something that, I did it a couple of years ago. Obviously, I play a lot of golf and stuff like that. I went and marshalled at a golf course for a little while. So, just you kind of tee time and setting people off on the first tee, stuff like that. Got to play the golf course as well and things like this. Again, it wasn't for the money or anything like that. It was something that disconnects me, takes me away, gives me something else to focus on. Doing things outside, and a little part-time job might be good for that. And that might sound weird for some people, thinking, why would I go and get a part-time job? But it's nothing to do with the income per se. It's more a case of to do with disconnecting and coming away from the chart. So it might not be that route, but definitely find something that enables you to step away and not be fully immersed all the time. Because like you said, you'll find a reason to trade. If you think about it, trading and investing, what you're doing most of the time is finding a reason not to do something.
So true.
If you can, if something just ticks all the boxes and you can't find anything wrong, well, then it is meeting all of your rules, right? But it's not about trying to find something, because you will find something if you look long enough. So have a system, have your rules, follow them, whatever that particularly, that edge is for you as an individual. Stick to it, and then have a way of being able to disconnect, whether that be personal things, work things, whatever it is. Doesn't really matter. But you've got to be able to get away from sitting staring at a chart. It's no good.
That it really hits home for me when you talk about it like that, because I went through this exact journey when when I quit my day job, I wouldn't say I was ready to be a full-time trader, but that was my ambition. And actually, I found the small performance that I had, or the thing that I was good at when I decided to quit my job, became terrible when I had no money coming in.
Yeah.
And I had this dream. I was like, fuck the 9 to 5, I'm done, I'm out of the system. And then the moment I went back to trading and I realized at the end of the month I didn't get paid, I was screwed psychologically, right? And it was having to go through it. For me, again, it was a very conscious process of, what do I actually do with my time now? And it was a lot of the reason, and I never shy away from this, it was a lot of the reason why I ended up going into the coaching business. I needed something to keep me busy, because otherwise I would be in and out the market 500 times a day.
Yeah.
Genuinely, especially if you're a short-term trader and you're watching a 1-minute chart, you think about how many potential opportunities you get when you're watching a 1-minute chart. You can easily justify a reason to be in and out, and it's like the worst thing potentially
100%,
for you.
100%. You've got to get away from it.
The other thing that really hit me, and I'm going to take this a little bit off topic for a second, but the other thing that I personally found from my experience, and I would love to hear how you either coped with this or if you experienced the same. When I transitioned from going from a full-time job to, at that point, trying to become a full-time trader, I felt like almost there was parts of my mind that carried on from the 9 to 5 mentality that actually didn't work so well in trading, right? And again, this is something that I talk a lot about, and I find a lot of people that tend to do well can resonate with this. And this is that when you have a 9 to 5 job, there are only 2 ways to make more money. You either work longer hours or you have to be more skilled at what you do. And for me, this is a perfect reflection of the trap that most retail traders get stuck in. So when they either go through a period of underperformance, or maybe they're new to the game and they think about, how can I be better at what I do? There are 2 things that they usually turn to, and especially this is amplified if they're coming from a typical 9 to 5, is they think, I need to stare at my charts longer. I need to spend more time analyzing. And for most people, it's technical analysis, right? Which is ridiculously subjective. And you can always find a reason to be in and out of the markets. Or they think, I need to improve what I'm doing, and I need to learn a new strategy, and I need to tweak something, I need to refine something. And actually, I think what experience teaches a lot of people is actually what you need to do is the complete opposite. You need to spend less time on your charts. And once you know the basics, stick with that, right? Because it's often we overcomplicate it. We get analysis paralysis, I think especially a lot of short-term traders, and you just get stuck in a position where you're overthinking things, and that's the worst thing for you in terms of at least mental clarity. Did you ever find you had that going from being the personal trainer to going into the markets as well?
I don't think I ever personally experienced that, but I think it comes down to being very routine, driven, being very process driven as an individual and stuff like that. So I've always found it easier where it's a case of, well, if that doesn't meet my rules, if that's not what I do in this, then why would I do it? That's not part of my approach, so why would I do that kind of thing, right? I'm quite a logical person as well in that sense. It's just kind of the way that my brain works. So I'm just like, well, if 1 and 1 equals 2, so why am I going to go and do this over here? It doesn't make any sense. But yeah, I definitely see how people could maybe struggle with that, and I guess that kind of then again ties into the things we were talking about earlier on in knowing your edge, knowing your process inside out. Because if you understand and know all those things, and let's just create a random example here. Imagine that your rules stated that you're best off trading X asset around the London Open because for what you trade gives the best volatility, best opportunities. That's where most of your money is made through the back testing and the data that you've done. Well, if you now know that inside out, why the fuck would you stare at a chart at 2 in the afternoon? There's no logical explanation for that, right?
Yeah.
But the main reason that you would probably go and be looking for opportunities in the afternoon is because you don't know those other things. So you've got to know your system, your strategy, your edge inside out. And I think when you really, truly understand it, and you've really got it refined and down to a T, it makes the other part a lot easier. I think if you don't have this bit, then you're a little bit erratic, like a little bit scatty anyway, and you're a bit all over the place. So it becomes very easy because you don't actually truly know what you should be doing. You don't really have a process. So you're kind of just going, well, this happens, I like to buy or sell. So now you're trying to just find it at any random time or whenever. You're not actually really following a process. So I think a lot of it comes back to understanding and refining that edge really down to a T. And then it will make the practical application a lot easier to actually do.
Yeah, I think the thing I find most interesting is whenever I get into this line of conversation about understanding your edge, And again, I'm always going to root this back to the psychology side. It's my niche, just my passion. I know it's not your fault.
You're trying to sell yourself here, aren't you? Sign up to mentoring. Trading in the now on Instagram.
You're doing my advertising for me. There's a big part to this where I feel like a lot of people are stuck nowadays because they think their edge is in their ability to predict the market. And I think the more you get to know your data and your numbers, when you actually break down a profitable approach to the market, it comes down to usually one thing. You manage risk very well, right? You manage risk in a way that your approach either allows you to win more than you lose, or you make sure that your winning trades outweigh your losing trades, right?
Yeah.
That's the only reason an approach works from a mathematical perspective, right? So what most people should, I think, take away, either whether it's in terms of your psychology or your general approach to the market, is your edge is not your ability to be Mystic Meg and predict what's going to happen next. No level of knowledge or analysis is going to stop you from making stupid decisions in the market, right? It's about how much they cost you, right? And the moment you can minimize and, draw a line in the bottom line to stop it really hurting the bank balance, is the moment you can allow your upside to just thrive and go with it.
Yeah, I think what we've always, we can sit here and we call ourselves traders and investors and make it sound good. The bottom line is what we're always doing is we're taking a probability-based bet.
100%.
That's all you're basically doing, 100%. Right? What you're essentially trying to do is you're trying to act like the casino.
Yeah.
Right? So the casino has a statistical edge in every single game within that building. All it now needs to do is play enough games. This guy might make a lot of money that day. This guy might do whatever. They just know that over the course of enough games, they're always going to make money.
Yeah.
That's basically what you're doing. You're sitting there saying, right, if I do X, Y, Z, I have a statistical edge. But then as we've said, I always look at it, it's a three pillar process. Your trading system and understanding that from a statistical aspect, your edge. You then got the risk management and you've then got the psychology. You need all three of these to actually be successful
100%.
long time. Best edge in the world, no risk management, you blow up at some point. You have the best two up here, but if your head's all over the place, you won't implement these, you fall apart.
Yep.
You could be a monk-like individual with your thing, but if you can't fucking trade, you can't trade, right?
100%.
So it's, this is why I always laugh when people go, oh, it's 90% psychology. All right, cool. Have a shit trading strategy, but be really, really calm when you're executing it, and you tell me if that's now solved your problems. Because it hasn't.
100%.
They're all just as important as each other. I don't think one outweighs the other. Like I say, look at a three-pillar process. You've got to have all of them. So that's when it, kind of putting that all together, it's a statistical probability-based bet. That's all it is. Don't, confuse yourself that you're doing anything, like you said, magical and predicting or anything like that. All you're saying is that when I use a system that includes this, and this, it means that more often than not, this is the outcome.
Correct.
That's all it is.
Yep.
You have no fucking idea what's going to happen. And anyone that tells you they know what's going to happen is lying to you, right?
Yeah.
But by doing these things, this is normally the outcome. Okay, that's cool, but it's not always the outcome. So that's where the risk management then comes in, right? We've got to make sure that we're managing our risk, we're managing our exposure. So when those times when we're not right, and we said earlier on those realistic probabilities of a drawdown, how many losses in a row, things like this, we make sure that that is now limited and contained to only denting our account by X amount. Then, of course, it's working on that top level in the psychology that helps you actually then be able to stick to this. Because without the psychology, you don't actually implement this correctly. You don't follow the right risk management. You don't follow all your rules. You start to break them. It all crumbles down. So all of those complete an overall trading process. You can't just focus on one or the other.
Yeah, well said. Well said. All right, I think we'll start to wind things down. There's usually an exercise that is... I don't know.
You're not going to make me meditate, are you?
There's an exercise that I like to throw out for a lot of people. It's kind of becoming a little bit of a tradition, and I'm actually really enjoying hearing everybody's responses to this.
Okay.
So the exercise is I'm going to give you a hypothetical scenario, which is you are now the owner of a hedge fund.
I'm going to sell it and run away with the money.
Yeah.
Problem solved. Thanks for coming. Job done.
Great jobs.
See you guys. See you all next week.
Probably the best response so far, right? You're the owner of a hedge fund, and your job is to hire traders, right? You need to fill up your floor. You need to hire traders. Hypothetically, you're in a position where you can't see a track record. right? And I know this is something that you're big on, so I'm about to...
So I'm hiring a Twitter guru. That's what you're telling me. There's no track record that exists. Is that what we're getting at?
Pretty much, right?
Okay.
There's no track record that you can check, right?
Yeah.
But everyone claims to be profitable. Basically, this is fucking Twitter.
On Twitter, right?
What characteristics are you looking for in a person that may indicate that they have a good chance of actually being a profitable trader?
Well, honesty would be a good one.
Okay.
Because I think then the reason I say honesty is because I think a lot of people they try and cover up mistakes and things like that. Someone that's honest will be able to find a solution to the mistake. So I think that's a big one. Somebody that's quite a calm individual, because no matter how refined your trading process is, there's going to be stressful times of things when it goes against you, etc. So, being calm is obviously a big one. I don't really know if there's a way that you can define how somebody sees risk, in terms of from a generic aspect, not from a trading aspect, but are they somebody that thinks in probabilities, basically, right? So I don't really know how you'd kind of work that out, but you want to try and find someone that's quite a logical thinker, I think. So someone that's honest, someone that's very logical, someone that has the ability to maintain calm under high pressure situations. I think if you've got somebody that has that makeup, then even if they're not profitable, let's say they are from Twitter, at least you can then teach them to be on top of that, right? So they might have been lying up until now, but at least you can then take them across to that.
Nice.
So I think that those sorts of things would definitely help.
Beautiful. I like it. Ben, it's been a pleasure.
Absolute pleasure, mate.
For anyone, and I'm sure there are many that are going to listen to hearing you speak today, what is the best place for them to come and find you, follow your journey, learn more from you?
Twitter's the best place. Twitter is my favorite. I technically am on Instagram, but I don't really post much. So Twitter would be the best place. That's just literally the handle is going to be @BenSparham _ be the best place to find me. And then, anything else from there, you'll be able to find from there, really. So I'd say give me a follow on Twitter, and that'd be the best place.
Perfect. Awesome. Guys, I hope you enjoyed this episode. Make sure you go and follow Ben. As always, and as promised at the start of the episode, he's been a wealth of knowledge. I know myself, I've taken away a lot from today, and I'm sure you guys have too. Make sure you subscribe to the channel if you enjoyed this episode. And as always, leave a comment with your biggest takeaway from today's episode. I'll see you very soon. Take care.